The beauty of fixed rate loans is that you are eliminating one of the variables of your investment strategy, which is that your loan has a fixed interest rate for a certain amount of time. Typically, fixed rate loans will have a 5-year, 7-year, or 10-year term. So the way that we think about it is, depends on your business plan and what's right for the asset, as well as what are you looking for in terms of, well, I guess I would say, how much do you like the rate? I would say when the interest rate is very low, that's when you want to start considering a longer term loan. The cycle is near the top. Obviously, we can't predict where we are in the cycle, but we can have a feeling whether we're closer to the bottom or the top. As the cycle gets more competitive and you're closer to the top, you might see a down cycle coming. You want to lock in longer term debt to be able to ride the down cycle and then come out of it. And then conversely, if you're at the bottom of the cycle or near it, like where we are today, you might want to consider shorter term debt, like 5-year debt, because you'll be able to more quickly ride up the cycle and then monetize the value created of the upcycle. When the 5-year loan approaches maturity in 3 to 5 years, you can then refi or sell, like I said, capturing the value created in that upcycle. One thing I want to talk about though about fixed rate debt is that fixed rate debt isn't fixed until right before you close. And that's just the nature of the beast. It's the way that these commercial loans work. Is just because you get an application approved or a term sheet signed up, it doesn't make the fixed rate loan actually fixed at today's interest rate. So when you go under contract, when you're initially bidding on an asset, you actually have to go through the due diligence process, go through the loan application process, and all the while, your fixed rate loan is actually floating. And this is very confusing for investors because you say, yes, it's a fixed rate loan, but no, we're not quite fixed yet. So we remain exposed to interest rate risk. And so unfortunately, that's just a risk of the business. And fortunately for you, our investor, you don't take that pre-closing interest rate risk, because if for whatever reason interest rates go up too much to where the deal is no longer the same, it doesn't pencil anymore, we would actually terminate the contract, back out, or renegotiate with the seller and give your money back, rather than eating the difference and being forced into a bad loan. So you as the investor actually don't take fixed interest rate risk pre-closing.